So I heard one of your interviews, and I also get your monthly newsletters, and I really like the fact that you have such a big focus on asset allocation. I like the fact that in your strategist monthly reports that come, it always starts with correlation of various asset classes. You have a correlation of India equity, US equity, gold, debt, and a lot of other stuff. Okay, so why is this focus of asset allocation so important when equity in India itself has become it's like fixed deposit? People are taking it for granted. 1% per month तो ऐसा ही बन जाता है, 12% per year तो ऐसा ही बन जाता है, small cap, mid cap में तो 30-40% बन जाता है. And here is Ashish Shanker talking about asset allocation.
Yeah, so look, you also have a capital market background and you've seen cycles, right? Markets, life, both are very, very cyclical in nature. So I think asset allocation is like a balanced thali, right? You have more of desserts or you have more of mains, your stomach is going to get upset at some point in time, right? So if you don't want to have an upset portfolio, you need to have a balance. So asset allocation actually solves for 95% of the problems in investing, because 95% of asset allocation determines 95% is determined by asset allocation. The outcomes, the portfolio outcomes are determined by that.
Not security selection.
Not security selection, right? So it's extremely important. But what happens in a market like this, right? People get carried away because making money becomes so easy. I mean, it's like a dartboard, right? You just throw darts at any company out there and you suddenly see after a year, your portfolio is up 40-50% and you tend to get carried away. So it is extremely important at this point in time, at this juncture, for us to keep reminding clients not to forget their core risk appetite and asset allocation. So I always keep telling clients, your risk appetite is how you felt when markets fell 40% during COVID.
March 2020.
Right? Your risk appetite is not what you're feeling today, right? What you're feeling at the worst is actually your risk appetite. Now, for a lot of people whom we've worked with over the years, right? I've been working with clients now for 10 years, 15 years, 20 years. I imminently know their risk appetite. So a lot of times when they get excited, right? And they say that, Ashish, let's put more money in equities. I tell them, look, calm down. Let's stick to where you are right now. And we'll see. Let's see the next 1 year. And markets are cyclical, and who knows, even in the biggest bull market that I have witnessed in my career, 2003 to 8, markets fell about 30% in 2006. Right? So that could happen even in this bull market.
Which is in a longer bull market, you have a sharp fall in the middle somewhere.
You could have that. So I think it's extremely important not to forget your risk appetite, and asset allocation solves for that, and it smoothens the ride. So I'm a big believer that you should have equities, you should have fixed income, and you should have gold as well, because gold acts as an insurance. I always say that it's the protector of capital in dire times.
In whichever format you choose. Could be an ETF, could be whatever.
Absolutely.
You have an ideal thing right now? I mean, an ideal asset allocation. I know that the requirement for every investor is different.
Right.
So that's a caveat to the audience as listening to this. It also depends on your risk return profile and your objectives. But in general, like one of the most popular asset allocations was simply 60-40. 60 equity, 40 debt.
Absolutely.
Or 100 managed age. Do you think that's still a good thumb rule to go with?
Yeah, so two thoughts there, Anupam. I mean, I keep it normally very simple. I always say that there are three asset allocation models. Right? One is 25-75, conservative. 25-30 equities and 75 debt and possibly 5% in gold.
Okay.
Right? The balanced portfolio, where you have 15 equities, possibly 40 in debt and 10 in gold. Right? And the aggressive portfolio, where you have 75 in equity, but then you have more in gold. You have 15 in gold and 10 in debt.
Okay.
Right? These are the classical portfolios. And the best time period to readjust your asset allocation is once every year. And we've done a study for 30 years. It works beautifully. I just want to add one more strategy, which we have backtested for 30 years.
Nice.
And we call it the all-weather strategy. And it works beautifully. Okay. It's the 5 asset strategy. The 5 assets in that are cash. Okay. Cash is an allocation. Debt. Then you have Indian equities, US equities, and gold.
Wow.
All in equal proportion.
And all not correlated to each other.
Absolutely. All in equal proportion, balanced once a year. This portfolio never loses capital on a 3-year rolling basis.
3-year rolling return is always positive.
Yes, and the average outcomes are between 9-11%.
Oh, not bad, eh?
So for someone who's moderate in risk profile, if they follow this asset allocation, I can tell you'll never be disappointed.
Wow.
And we run this on one of our platforms.
And reasonable volatility, not big
Yes.
drawdowns, because I
No
saw
big drawdowns.
I saw the numbers on your in your PDF. I mean, the drawdowns on debt, hardly. The
Yes.
drawdowns on US equity is actually much better than the drawdowns that we have out here in India.
Correct.
And gold mein to drawdown pata nahi.
So I'll tell you something which is very contrary to people's belief system. Indian equities and US equities have the lowest correlation.
Okay.
It's 0.3.
Is that right?
Yes. So when US equities does extremely well,
Huh.
Indian equities doesn't do that well.
Okay.
And vice versa.
Right.
So anybody who asks me, should I do global diversification? The answer is yes for again HNIs and ultra HNIs who have large capital. But when they ask me which geography should I invest in, I mean, I tell them US is the only place you should be investing in. Because it gives you best in terms of diversification and correlation.
And it's largest and most liquid, na?
Absolutely.
Why do you want to be in some random country with some random this when the time comes to exit? The doors are closed. US never has that.
Correct. I let me also address your other question, because that's a very interesting question. Should it be 100 minus your age equities? Now the classical studies say yes, but I have a very contrarian philosophy there. See, for people who have created wealth above a certain number, actually, debt should be a finite allocation, not a percentage.
Oh, in absolute numbers.
Yes, because your wealth is going to outlive you. So you can actually potentially take far more risk than you believe. Because a large part of the wealth is actually going to go to the next generation.
So you should, that's a longer timeline.
Absolutely.
And if you have a longer timeline, you should increase the risk.
The moment you go above a certain number in your portfolio, right? When your basic needs are met, and you, like I said, a lot of ultra HNIs have created wealth for the next 1 or 2 generations. Then you should start thinking of debt in terms of finite number other than allocation.
So an absolute corpus where the capital is preserved and you just live off the returns and you're kind of sorted with that.
Yes.
Chalo, theek hai. Enough. Now our favorite kya lagta hai sawal, like outlook on stock markets. I can't think of a longer period year on year where you've got positive returns. This 8% correction that we've had in October reminds me of exactly last year October. Because last year October, when the market fell 8%, it was up 40% the next year.
Correct.
And here we are sitting now on a similar 8% on the Nifty.
Correct.
Obviously sharper on the small and middies, which is fine. Where do you go from here? With, I think 20,000 crores. Is it the SIV number?
Yes, it's more. It's bigger. It's getting bigger every month.
So 3 bill per
around
month.
25,000, I think.
So that's about 3 bill per month multiplied by 12. So 40, 50 billion coming in from there.
Correct.
What do you think here?
So Samvat to Samvat, right? We're entering the new Samvat. Nifty is up 24%. Mid cap, small caps are up more than 30%. Portfolios are up 40% plus. So it's been a great year. And come to think of it, last year, same time, planes were flying over Taiwan. We were worried about a third world war, right? So we should be very happy with the outcome, first of all, regardless of the 7-8% correction, right? So I have a framework, Anupam, on bull markets, right? If you look at history, right, typically bull markets last anywhere between 5 to 8, 9 years, right? And markets tend to expand anywhere from 5 to 8, 9 times. Okay, and US has a longer history, India has a relatively shorter history. Now, if I look at the last big bull market, and I keep visiting that, and probably the mother of all bull markets happened in the 90s, but it happened in a very shorter time frame, right? Harshad Mehta.
And it was not exactly believable, so to say. But
Correct. So, I believe that this bull market has the makings of both these bull markets combined, because 92 a lot of domestic liquidity came in, right? How it came in is a different issue. In 2003 to 8, a lot of foreign liquidity came in, but it was also driven by fundamentals, right? Earnings growth was phenomenal.
Economy was doing well.
Economy was doing extremely well. This time around, if you see, the stock market price growth has been backed up by fundamentals.
Correct.
The other statistic I'll give you, Anupam, this will be, I think, the 5th financial year where you'll have double-digit EPS growth for the index.
Oh.
It's never happened in the history of stock markets.
Lost track of the EPS number completely. Okay.
It's never happened, including 2003 to 8. Okay. So there is a very strong fundamental backbone to this rally.
Sure.
A. Second, a lot of sectors are participating. And I don't believe that bull markets mature in these kind of circumstances. Right? So I still feel we have a long way to go. Right? So in very simple terms, I say, अगर बॉम्बे से पुणे जाना है तो हम लोग लोनावला पहुंचे हैं.
Nice.
अभी और time है.
Okay.
Okay. In between this, yes, the difference between your travel and bull markets is you can come back from Lonavala to Karjat and then resume your journey from Karjat to Pune.
Yeah.
Right? So, people who are invested should stay invested. There is still a long way to go. In terms of sectors and themes, the other question that you asked, generally the sectors and themes in a bull markets don't change. Right? They rotate. So, for example, PSUs, defensives, cyclicals have defense and cyclicals have done extremely well. So much so that valuations have got massively overextended in defense. They've corrected 20-30%.
Sure.
PSUs have also corrected.
Sure.
So that happens. So maybe they take a breather. But the core themes of this bull run are, according to me, digital. Right? Any company which is a digital platform has exponential leverage. Those will continue to do well. Second, engineering, cap goods, cyclicals are at the core of this entire bull market. Third, capital markets.
Interesting.
Any companies which are at that inflection point of channelizing savings from traditional bank deposits to capital market savings are in a very, very sweet spot.
Whether it is product manufacturer or intermediary or whatever.
Absolutely.
Okay.
Fourth, real estate.
Nice.
Right? So these are some of the themes that we like. Yes, intermittently what happens is, pharma as a theme didn't work for 3-4 years. Now it's bouncing back. IT is like a contrarian theme right now.
The biggest one, private banks.
Cheap. I think banks will underperform. Private banks will underperform. So I'm a big believer of this rally being led by non-banking players.
Very interesting.
Intermediates.
So private banks haven't gone anywhere, by the way, for the last 2-3 years.
They'll struggle because they have a lot of challenges.
Even with the falling interest rate regime coming in the next 1 year.
Yeah, NIMs are under pressure and credit growth is slowing down. See, think about it. If you're getting equity at 2% yield, why are you going to go and borrow from the bank? You see the number of QIPs which are getting launched.
Yeah.
Right? If your P is 50.
Yeah, but I'm just wondering, then how does that equation play out? You can't have banks sitting out of an economy expansion. Like, somewhere or the other, something should work. I don't know.
I think maybe in the later stages of the bull market, they will participate. But even lending, if you see, NBFCs are growing faster than banks. I think somewhere RBI is also, trying to keep checks on banks. So they have come down very heavily on banks on the unsecured portion of their balance sheet. RBI is willingly, I think, keeping money tight, right? So the NIMs are getting compressed as we speak. There is a fight for deposits. So banks will participate. All I'm trying to say is that the leaders of this bull market may not be private banks.